In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline Reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Correnti, and today's reaction, 1031 exchanges. A 1031 exchange isn't a strategy for making a deal good. It's a strategy for preventing a good deal from getting diluted by taxes when you sell. Quick disclaimer before we start. I'm not a CPA, not a tax attorney, and not a tax professional. This is educational and general in nature. 1031 rules are strict. Outcomes depend on your situation, and you should consult your own tax advisor and qualified intermediary before executing anything. All right, let's define it clearly. A 1031 exchange, named after Section 1031 of the Internal Revenue Code, is a tax-deferred exchange that allows an investor to sell an investment property and reinvest the proceeds into another investment property and defer capital gains taxes. The key word is defer. A 1031 exchange doesn't eliminate taxes. It pushes them forward. It preserves equity today so you can compound it into the next deal. If you've ever heard someone say, real estate investors don't sell, they exchange, this is what they're talking about. Now let's walk through why it matters. In commercial real estate, taxes at exit can be significant. You may have capital gains, you may have depreciation recapture, and you may have state taxes depending on the jurisdiction. The result is that even a clean, successful exit can lose a meaningful percentage of proceeds to taxes. And here's the practical impact. Those taxes reduce the amount of equity you can roll forward into the next investment. A 1031 exchange is designed to protect that equity. So instead of taking chips off the table, the investor keeps them in play. Now, the part most people get wrong is thinking a 1031 is just paperwork. It's not. A 1031 is an execution exercise with real deadlines, real constraints, and very little margin for error. So let's break down the mechanics. There are three core requirements that drive most 1031 outcomes. First, the properties must be held for investment or productive use in a trade or business. This is not for a personal residence. This is generally for investment real estate. Second, the exchange must be structured correctly through a qualified intermediary. You cannot take possession of the sale proceeds. If the money touches your account, the exchange is generally blown. The qualified intermediary holds the funds and facilitates the exchange. Third, you have two key timelines. You have 45 days from the sale of your relinquished property to identify replacement properties. And you have 180 days from the sale to close on one or more of those replacement properties. Those numbers matter because they create pressure, and pressure changes behavior. Now, identification isn't casual. The IRS requires written identification of the replacement properties within 45 days. And there are rules around how many properties you can identify and how those values relate to the value of what you sold. So in the real world, investors often pre-plan replacement options before closing the sale because the clock does not care if you're still negotiating. Now let's talk about what makes an exchange actually work. A successful 1031 exchange usually requires three things: planning, liquidity discipline, and replacement quality. Planning means you're thinking about the exchange before the sale closes, not after. Liquidity discipline means you're prepared to move with speed because the timelines are not flexible. Replacement quality means you don't sacrifice the next deal just to save taxes on the last one. And that is the single biggest trap of 1031s. Because the exchange can turn a smart investor into a desperate buyer. They sell a great asset. They have a tax bill hanging over their head. And now they have 45 days to identify, 180 days to close. So instead of selecting the right next asset, they select the available next asset. And that's when the reaction fails. So let's dive in with a case study. Case study 1, the exchange that preserves equity and improves the portfolio. Assume an investor bought a small multifamily building for $6 million and held it for 5 years. They executed their business plan. Rents grew and the market moved in their favor. They sell the property for $9 million. On that sale, they're facing a meaningful tax exposure, capital gains, and likely depreciation recapture. If they sell outright, a portion of proceeds leaves the portfolio permanently. Instead, they execute a 1031 exchange into a larger, more durable asset. They identify 3 replacement options before the sale even closes: a grocery-anchored retail center, a stabilized industrial building with long-term leases, and a newer multifamily asset in a stronger submarket. Within 45 days, they formally identify all 3. Within 180 days, they close on the industrial replacement property. What changed? They preserved more equity. That equity became additional buying power. They also upgraded the risk profile, moving from a smaller asset with more management intensity into an asset with longer leases and more durable income. This is what 1031 is supposed to be, a tax deferral strategy that supports portfolio engineering. Now, case study 2, the exchange that forces a mistake. Assume the same $9 million sale, but the investor did not plan ahead. They go under contract, close the sale, and only then start searching for replacement properties. Now they're racing the 45-day identification deadline. They find a deal they don't love, a transitional office asset with near-term rollover and a leasing risk they didn't plan for. But it's available. The timeline is tight, and the investor says, "I'll make it work." The investor identifies it, they close it, they complete the exchange. Technically, it succeeded, but economically, it may have failed because the replacement asset introduces new risks, leasing downtime, capital requirements, and uncertain demand. So the investor deferred taxes, but traded into a weaker deal. This is why sophisticated investors don't let the tax tail wag the investment dog. Now, here are the most common failure points you should know. 1. Missing the 45-day identification deadline. 2. Failing to use a qualified intermediary correctly, particularly touching proceeds. 3. Buying a replacement property that is lower value or financed incorrectly, which can create taxable boot. Boot is essentially when the exchange isn't fully like for like in terms of value or reinvestment, and part of the transaction becomes taxable. 4. Replacement quality. This is the big one. A rushed exchange can push investors into deals they wouldn't normally buy. Now let's talk about how this connects to institutional decision-making. Institutional investors and experienced operators treat 1031s as part of exit planning, not a tax trick. They underwrite the exit, the likely tax exposure, and the reinvestment path before they sell. In many cases, they are already sourcing the next asset while operating the current one. They're creating optionality, because optionality is what prevents forced decisions. The takeaway is simple. A 1031 exchange is a tool for deferring taxes and preserving equity, allowing investors to compound capital into the next investment. But it comes with strict timelines, structural requirements, and real execution risk. The best exchanges are planned well in advance, executed with discipline, and used to move into a better asset, not just any asset. Now, before we go, consider the following 10-point 1031 checklist. 1. Confirm eligibility. Make sure both the relinquished property and replacement property are held for investment or business use. 2. Hire a qualified intermediary early. Set up the QI before closing. Never let sale proceeds touch your personal or entity account. 3. Plan before you sell. Start sourcing replacement options while the sale is still in process, not after it closes. 4. Know the deadlines. You generally have 45 days to identify replacement properties and 180 days to close. 5. Build a replacement pipeline. Identify multiple viable options so one failed deal doesn't blow the exchange timeline. 6. Prioritize deal quality. Don't let tax deferral push you into overpaying or accepting avoidable risk. 7. Avoid taxable boot. Reinvest appropriately and structure value and leverage thoughtfully to minimize taxable proceeds. 8. Pressure test timing. Confirm diligence, lender underwriting, and closing schedules are realistic within the 180-day window. 9. Plan with your tax team. Confirm basis, depreciation history, entity structure, and state tax considerations before committing. And last but not least, 10. Document everything. Keep identification notices, qualified intermediary paperwork, and transaction records clean to avoid execution errors. That's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Correnti, and thank you for your time.